Between the years 2019 and 2023, a completely new payment infrastructure materialized across the entire global retail economy. This chart tracks the total value of originated buy now, pay later loans. In 4 years, that volume scaled from 2.7 to over $45 billion. Alongside that surge, tens of millions of consumers integrated this credit ecosystem into their regular shopping habits. These figures come directly from market monitoring conducted by the Consumer Financial Protection Bureau and the Federal Reserve. In conventional retail strategy, removing friction at the checkout is universally treated as a positive. The logic is straightforward. Giving buyers access to interest-free credit generates more sales, which scales up total operational profit. Recent economic modeling reveals a counterintuitive reality. Introducing a massive influx of new, credit-enabled buyers can actually incentivize a retailer to carry less physical inventory and walk away with less overall profit. Ultimately, eliminating payment friction introduces a hidden structural cost that quietly erodes operational efficiency from the inside out. To see how this macroeconomic shift damages retail efficiency, we have to isolate the mechanics of a single transaction. A buy now, pay later purchase relies on a three-party network: the consumer, the retailer, and a fintech provider. On day one, the consumer pays a 25% down payment out of pocket, and the retailer immediately hands over the physical product. Simultaneously, the fintech provider pays the retailer the total purchase price upfront, minus a specific 5% discount fee kept as compensation. Over the next 6 weeks, the consumer pays the remaining 3 installments directly to the fintech provider, bypassing the retailer entirely. This is what the pay-in-4 structure looks like to a buyer. A $1,282 total is split into one immediate payment, followed by 3 equal interest-free installments spaced exactly 2 weeks apart. In this arrangement, the retailer is completely shielded from consumer default risk. The fintech provider absorbs that hazard, generating its revenue on the spread between the discounted upfront payment and the full repayment collected from the consumer. This three-way relationship creates a complex market equilibrium. The retailer sets the final product price and orders physical inventory, while the fintech calculates its discount fee based on its cost of capital and the projected default risk of the buyers. The moment a retailer accepts these installment loans, their customer base fractures into 2 distinct demand channels based entirely on liquidity. Cash liquid buyers who pay the full price up front yield the maximum nominal revenue margin for the business. Cash-constrained buyers utilizing the financing option yield a lower margin because the fintech discount fee is subtracted from every one of those transactions. The structural problem is that regardless of how a customer pays, both of these segments draw from the exact same finite pool of physical inventory. As the proportion of financed purchases scales up, the higher volume of lower-margin sales drags down the blended revenue per unit across the entire business. Because these 2 payment channels share a single inventory pool, a massive spike in total unit sales mathematically reduces the average profit earned on every item leaving the warehouse. Retail operations run on a continuous balancing act. Managers must weigh the upfront cost of ordering too much stock against the lost revenue of a missed sale. In high-volume environments, these risk calculations dictate promotional pricing and determine exactly how many items actually make it to the shelves. When that blended revenue per unit shrinks, the financial penalty a retailer feels for running out of stock and missing a sale also drops. As the reward of a marginal sale decreases, the heavy, sunk cost of holding unsold inventory dominates the economic equation. The mathematically rational response for the retailer is to protect themselves from this overstock risk by intentionally ordering and holding less physical stock. Introducing frictionless credit into a consumer market results in lower overall product availability. A system designed to make purchasing easier engineers physical scarcity. Faced with shrinking unit margins, retailers deploy their primary defense mechanism. They raise the nominal retail price across the board. The surface-level logic here is obvious. The retailer is attempting to pass the fintech provider's discount fee onto the consumer base to protect their baseline profitability. Economic modeling reveals a secondary function to these price hikes. They act as a mechanical screening filter for consumer liquidity. Because these loans require a 25% down payment, raising the total retail price automatically scales up the immediate day-one cash requirement for the buyer. This larger upfront cash hurdle naturally screens out the highest risk, most cash-poor buyers who can no longer afford the initial down payment. This creates a highly specific feedback loop. Filtering out the riskiest buyers lowers the overall default rate of the purchasing pool, which then allows the fintech provider to charge the retailer a lower discount fee on future sales. Under an installment system, higher retail prices serve an active, strategic purpose. They operate as a screening mechanism used to manipulate the default risk of the customer base. Third-party financing operates as a powerful operational optimizer under the right market conditions. When a retailer's blended revenue holds steady or rises, the system works. Overall profits scale up, optimal inventory levels expand, and consumer surplus increases. The system deteriorates when a market is overwhelmingly dominated by illiquid, cash-constrained buyers. In this environment, the high volume of discounted sales causes the blended revenue to collapse. This chart details the average monthly open balances across different loan types. The towering green bars show that heavy installment loan users carry drastically higher student loan and credit card debt compared to non-users. This elevated default risk among the primary user base severely spikes the fintech provider's funding costs. To compensate, they demand steep discount fees from the retailer, which ultimately wipes out the store's profitability. The operational success of point-of-sale financing is entirely dictated by the pre-existing liquidity profile and the existing debt load of a retailer's specific customer base. Before integrating these payment networks, retail managers must answer 3 critical questions. Does our target market lean illiquid? Can margins absorb the transaction fee? How high is the default risk? A common assumption is that merely extending the payment timeline into more installments solves these operational frictions. The math shows it does not. Many executives treat buy now, pay later as a checkout conversion tool. Introducing point-of-sale financing acts as a structural financial lever. It recalculates the mathematics of how much physical inventory a business can profitably order and hold. Separating a consumer's desire for a product from their immediate liquidity permanently alters the retail supply chain ecosystem.